Welcome back to Miller Momentum. Today, we're going to talk about Ben Felix, a portfolio manager and the chief investment officer at PWL Capital, and why he is wrong about gold. I want to emphasize first, Ben Felix is highly qualified and generally has solid information to offer. He is a CFA charter holder and CFP professional. He is also securities licensed in Canada by CIRO. I feature him on my channel page as one of my favorite investment channels. But he is still wrong about gold, and the data proves it. Let's get into it. First, a disclaimer. I am not a financial advisor, and this is not financial advice. The content in this video is for entertainment and educational purposes only. Past performance is not indicative of future results. Statements made are my opinions. Investing involves risk. Always do your own research. Okay, so maybe saying Ben Felix is wrong about gold is a bit too strong. Let me back up just a smidge away from the title of my video and look at the objective facts on the ground. His video on gold showed up in my feed again recently. It's about 6 years old at this point, but you know how the algorithm works. And if you look at how gold's performed since then, it is tempting to just kind of laugh and say, well, I guess he was wrong. But that's a little bit too easy. His argument actually is solid on its own terms. It just doesn't touch on why I hold gold or how gold typically gets used in an all-weather portfolio design. So before I get into all that, let me steelman his case, lay out and fortify the 3 points from his investing in gold video as strongly as I can. Ben Felix's first point: gold has no real expected return because it's a non-productive asset. Compare that to equities, real estate, farmland, what have you. Those all throw off cash flow, right? Dividends, output, something that compounds over time. Gold doesn't. So, mathematically speaking, its long run, inflation adjusted expected return is actually zero. Any profit you make is really just betting that someone in the future will pay a higher price than you did. Well, kind of. Though it must be pointed out that gold does have industrial uses and has proven itself to be a durable store of value and one of the most enduring money technologies in human history. I mean, most of the world was on the gold standard merely half a century ago. But that aside, Ben Felix is correct on this point overall. Ben Felix's second point: gold isn't a reliable inflation hedge, at least not on any time frame that matters to you. This comes from research by Erb and Harvey. The real price of gold is just too volatile, short to medium term, so sure, it's held up its purchasing power since the Roman Empire, but that's a useless time frame for an actual investor, right? I'm pretty sure that your career isn't going to last 1,000 years. And there's a subtler problem here. Gold's real return is a global number. So if you're living through hyperinflation locally, Brazil in the 80s or 90s, say, you could still lose real purchasing power, right? If the global price of gold happens to be falling at the same time, and you need it in your local economy, then you're kind of out of luck. And I think this is something not a lot of people consider, especially when they're hoarding gold for a doomsday asset. Well, its price is only as high as the whole world wants to pay for it, not just where you're at locally. Ben Felix's third point: gold is a worse safe haven than government bonds. Yes, gold has low correlation to stocks, but its volatility is roughly as high as stocks in most cases, with no expected return to show for it. Bonds, on the other hand, give you better risk-adjusted returns in some regimes, and they reliably cushion the blow during a crash. Well, during most equity crashes. So putting your safe haven allocation into gold instead of bonds is, as Ben Felix argues, a real measurable cost. And this was absolutely true from about 1988 to 2019. Now, that's a pretty compelling case against gold, right? I mean, on the face of it, It's like, Geoffrey, why are you still investing in gold? Ben Felix has completely just demolished the case against gold. I don't understand what left is there to say. And to be fair, Felix presents basically the argument for why I'd rather rent my gold exposure through something like GDE or GDT than just sit on gold bullion. But I still hold gold as part of my strategy, and it's genuinely helped both my volatility and my returns, and will continue to do so. Here's why in 4 parts. The backtest that Ben Felix is using hides a regime shift. Physical gold doesn't carry counterparty risk, and that influences its trading price even within systems with counterparty risk. It insures against sequence of returns risks, and gold's volatility can actually be harvested. Let's start with the backtest Ben Felix used. Felix's conclusion that bonds beat gold as a safe haven comes from data running from 1988 to 2019. That's not a neutral window. That's 30 years of interest rates falling in a straight line, pretty much, which is exactly the environment that produces a structural bull market in bonds and a negative correlation between stocks and bonds. But look at inflationary periods instead, the 1970s or 2022 or maybe right now. And stocks and bonds are moving together. Bonds stop being a hedge right when you really need one. That's my argument, at least. Gold tends to show up precisely in those moments: negative real rates, fiscal dominance, stagflation, which is exactly where most bond funds fail. Second, gold isn't just a ticker on a chart. It's a physical bearer asset, and that matters. Stocks and bonds both carry counterparty risk, institutional risk, and jurisdictional risk. Gold doesn't answer to any of that, which is part of why its price keeps moving independently of capital markets. And we got a real world demonstration in 2022. When Russia's foreign exchange reserves got frozen, it proved that sovereign debt can be weaponized. Central banks noticed. China, Poland, and Singapore led a wave of record gold buying, precisely because gold sits outside the fiat and sovereign debt system entirely. It's backup insurance. That's institutional demand that has nothing to do with anyone's retail portfolio model. And yes, while renting gold certainly does carry counterparty risk, I'm not holding gold as a doomsday asset. No, I'm holding gold partly to benefit from the price action impacts of people who do hold gold as a doomsday asset. Now, I'm nowhere near as pessimistic as they are about the future, but their pessimism is extremely profitable at just the right time for people who use gold as a diversifier. And listen, a big portion of the gold community will never become less pessimistic. It's just not going to happen. It's human psychology. Central banks understand this fact deeply. My third counterpoint: yes, gold's long run expected return is zero, but treating that as purely a negative misses what it's actually for. If you're retired and drawing down your portfolio, a fiat currency crisis or a stagflation shock can force you to sell stocks or bonds at exactly the wrong time. That's sequence of returns risk right there, and it can be catastrophic. Gold tends to respond convexly to that kind of systemic stress. I mean, we've literally been watching this happen over the last few years. The cost of holding a non yielding asset is really just the price of having uncorrelated liquidity on hand when something breaks. Having insurance only looks like a dumb idea until something bad actually happens. Then, the calculus on opportunity cost can flip in an instant. Fourth, and this is the mathy one, because gold is highly volatile but barely correlated to stocks, it's a great candidate for systematic rebalancing, what's sometimes called Shannon's demon. I did a full-length video on this already, so go ahead and search my channel if you're interested. I won't get into it all right now. I rebalance once a year or sooner if percentages of my allocations move more than 5%. In practice, That means selling gold when it spikes during a panic and using that to buy stocks and other assets while they're depressed. Funds like GDE actually do a version of this internally because GDE holds basically the S&P 500 and gold together in a 90-90 ratio. On its own, just buying and holding gold drags on your returns. That's true. But disciplined mechanical rebalancing captures a volatility premium across market cycles, and that's what offsets gold having no yield of its own. Shannon's demon actually produces a kind of phantom yield from holding gold. So, where does that leave things? Well, Ben Felix is evaluating gold as a standalone asset competing with stocks and bonds for growth. And on that basis, his math holds up. My case for gold isn't that. It's about using gold as a structural diversifier and form of portfolio insurance, tested across the regimes where bonds don't do their job. Both of these analyses can be correct at the same time. They're just answering different questions and different concerns. So that's all theoretical, and theory is beautiful. But what about holding gold in practice? Let's say some guy named John, way back in 1968, got spooked about rumors that the United States was going to abandon the gold standard in upcoming years. So he started buying up gold jewelry wherever he could, and then started investing directly in gold as soon as it became legal to do so openly. So instead of a 60/40 stocks and bonds portfolio, John went with a 60/40 stocks and gold portfolio. Now, I'm not telling you to do that, and I don't do that. But I want to look at the most extreme example here to evaluate Ben Felix's thesis about the supposed opportunity cost of holding gold in practice. How did John do compared to his wife? Let's call her Mary, who decided to just stick with a 60/40 stocks and bonds portfolio. Well, let's take a look. We want to be good data scientists here, after all, right? Just because some guy with impressive credentials has a great sounding theory doesn't mean that we're going to buy it until we look at the actual data and evaluate the theory in practice. So let's assume that John and Mary both start with $10,000 in their portfolio and they're going to be making $50 in contributions on a monthly basis. And they're just going to do that from the start until the end of time, just to keep things simple. And let's also suppose that they are rebalancing annually unless one of their allocations moves by 5% or more. And then they're just going to rebalance at that point to keep their um, risk profile uniform. And because treasuries are most uncorrelated with stocks, we're going to assume that Mary goes with intermediary US treasuries instead of a broad bond fund. There's not really much of a difference in returns between them, but this way we just screen out all of the possible noise from corporate bonds that move a little bit closer to stocks. So she's getting the maximum diversification benefit here so that we are comparing John to a best case scenario instead of, having noise of corporate bonds included here. So we've got 60/40 bonds and 60/40 gold. How did they do over 60 years? Well, John won. I mean, he's up more than $2 million. His Sharp ratio is comparable to Mary's. I mean, it's just 0.51 compared to 0.50, so there's hardly any difference. He only has slightly bigger volatility. The max drawdown is fairly comparable. He had a little bit bigger average drawdown, but the returns, I'm pretty sure in John's eyes, may have been worth it. And not only that, he also got some psychological benefit out of this. It's hard to see until you shift to the logarithmic scale, which we're going to do right now. But during the 1970s, Mary would have felt a lot of pain as her 60/40 bonds portfolio struggled, whereas John was kind of literally riding on top of the world there and was above Mary all the way until the around the .com boom. And now Mary did outride him for a while after the .com bomb, and he was doing, fairly comparable, but a little bit worse than her, right up until the great financial crisis, when again, you had that fear factor driving people toward gold and a lot of central banks hoarding gold and some debt crises going on, which really hurt bonds. And from that point onward, well, John has been back in the lead. So I've got to be frank, I really don't see where Ben Felix is seeing a an opportunity cost regret here regarding holding gold as opposed to bonds. Now, in my own strategies, I hold both gold and bonds, and in particular, I hold catastrophe bonds because that's my favorite uncorrelated category of them. But again, we're looking at an extreme example here to stress test Ben Felix's theory, which is very elegant in practice, but in practice, it just doesn't seem to work. Okay, but maybe that's a bit of a straw man, right? Because Ben Felix was talking about just holding gold and never rebalancing, just holding it through good times and bad. And on that, in theory, I mean, like I said during the PowerPoint presentation part of this video, I agree with him. I agree with his points. But does the theory align with practice? I mean, has it held true over the past 58 years, the past 60 years? Well, let's suppose that John and Mary start with their 60/40 portfolios, John with gold, Mary with bonds, but let's suppose they never rebalance. They just have that starting allocation for their first $10,000, and whenever they put in $50 each month, they're just putting 25 toward stocks and 25 toward either bonds or gold. And let's see how it works out for them. So in this case, it's quite interesting. We see that Ben Felix's point is actually established by the data here. So Mary, in this case, has a higher Sharpe ratio than John at 0.46, and she actually comes out slightly ahead. She has a significantly lower max drawdown, a significantly lower average drawdown, a significantly lower longest drawdown, and significantly improved volatility. So, again, this just shows that this is a more nuanced conversation than most people make it out to be. If you're going to use gold in a portfolio strategy, it seems that the data supports that you should use it strategically and not just as a buy and hold asset on its own. You've got to have some plan to harvest gold's volatility to make it worthwhile, not only as insurance, but to make it worthwhile during those long times when it's functioning basically as dead weight, just kind of bobbing up and down. But if you are rebalancing, then harvesting that volatility using Shannon's demon, and again, I highly encourage you to go and watch the video that I did on that. It can be a really good asset if you use it strategically. But if you're just buying and holding, then yeah, Ben Felix is absolutely correct, both in theory and in practice. So, what's the takeaway here? First, never take what you hear about finances or investing at face value, especially if you hear about it on YouTube. That goes for my videos too. You've got to check things, even when they come from a respected, highly qualified authority. Often, the conversation may be more nuanced than it appears, and that authority may be speaking to different needs and practices from your own. Second, if you're going to hold gold, then the data would suggest that gold needs to be part of a portfolio with a rebalancing strategy to harvest that gold's volatility. Otherwise, you're going to risk underperforming a similar portfolio structure that just goes with bonds. Well, I hope you enjoyed today's video. Don't forget to hit that like and subscribe button. Do you invest in gold? Why or why not? Let me know down in the comments. I'll see you next time.